It's not just the banks, that are in trouble. It's not just the mortgages. It's treasuries that are a problem because the government is also broke. Part of the reason it's broke is because it bailed everybody else out. It took on all this debt, and it took on a lot more debt during COVID. You've got a national debt now that's almost 34 trillion. It's rising by about $1 trillion every 2 to 3 months. I mean, so you're talking about $4 or $5 trillion of new debt piling on to the existing debt. Meanwhile, over the next 3 years, half the debt matures, right? So talking about a situation like, you got a balloon payment. So all this debt is maturing, but it was borrowed. The money was originally, the loans were taken out and the government was paying, 25 basis points for that money, for 1 year paper, 2 year paper. Now it's 550 basis points. And when it matures, so the cost is going up by a factor of 10 to the government to have to pay the debt. At the same time, the debt itself is skyrocketing. So interest rates, or the interest expense, by the end of this year, it'll be about $1 trillion a year, almost, but it's more than we pay on defense. It'll probably double by the end of next year to be $2 trillion. And it'll mean that interest on the debt will be a larger expense than Social Security or Medicare. And then it's going to keep rising. And at some point, interest on the debt will consume 100% of tax revenue. In a couple of years, it'll probably be close to 50%, which is already, crazy. I mean, imagine going into a bank and you want to borrow money to buy a house, and you're already, and your debt payments are already 50% of your income. It's like, and I want to borrow more money. So, I mean, how is the U.S. government going to convince people to lend it more money when it's already devoting half of its tax revenue to paying interest on the money it's already borrowed? And of course, we can't even begin to repay the principal. We have to borrow that, because whenever the bonds mature, we have to find a new lender. We can't pay anybody back because we don't have the money. Now, of course, we could print the money, but that means it doesn't have much value. That means you have runaway inflation. And so that's, I think, where the markets are headed. And that's why I think it's more of a sovereign debt crisis and a currency crisis, because we have two options, both of which are bad. The first one is default, where the government defaults on the treasury debt, defaults on its commitments to, guarantee mortgages, whatever it is, and the lenders actually lose their money. But the alternative to that, which is actually worse, but more likely, is that the Fed does print up enough money so that the government doesn't have to default. But now we all get repaid with money that has very little value. And so in that type of inflationary default, in real terms, purchasing power, people end up losing even more money. And it's not just the creditors that lose money. Like if the government defaulted on a treasury, the owner of that treasury would lose money. But if you didn't own the treasury, if you just had cash, in your mattress, it didn't affect you. But if the government just prints up a bunch of money, or the Fed prints up the money so the treasury doesn't have to default on that mortgage, then if you have cash under the mattress, you've lost. That cash has lost purchasing power because everybody who owns dollars suffers from inflation. Insurance rates. Look, I just got my bill the other day for a house I have in Connecticut, and my homeowner's insurance was up 19% from last year. But last year was like a huge increase. It was almost like a double. And when I asked the realtor, or my insurance guy, what's going on here? And the big thing is the replacement costs for the parts, for the material, and then also for the labor. So if something happens to your house, it catches fire and we have to build it, it's just going to cost a lot more money to do it. And so they got to charge me much higher insurance rates. But also a lot of these insurance companies have lost a lot of money. They also, bought all these overpriced bonds when rates were low, and they paid out a lot of claims recently with natural disasters. So, they don't have the money. And a lot of high risk areas, if you're more, prone to, you're in flooding or, hurricanes or fires, the insurance company's like, we can't take the risk. We can't insure these properties because we're losing money. Most mortgages, they require you to have some kind of insurance on the property. But if you can't get the insurance, I don't know what they're going to do. If the mortgage is already there. But those areas, though, the prices have to start coming down, because if nobody can get insurance for your house, that's going to impact the value of that house. Because who's going to buy the house if they can't insure it? Only somebody who can afford to self-insure, or but you're shrinking your market of potential buyers, and then people will pay a lower price. But a lot of this too, a lot of the houses that exist in high risk areas, the government subsidized like a lot of times with flood insurance, the private sector wouldn't even underwrite it. And so the government said, oh, don't worry, we'll give you these cheap flood insurance policies. And okay, I'll build my house right by this river.
Yeah.
Whereas the free market would have kept people away or would have caused them to build in a way that would have mitigated the risk. Now, it would have been a more expensive construction project. But if the government just says, oh, don't worry, we'll subsidize your insurance, then that caused very risky behavior. Today, since the most valuable asset that the homeowner has, really more than his home, is his mortgage, a lot of people are going to want to stay in those homes. Even if the home price goes down, their mortgage is so low that it still might be cheaper. Let's say I've got a house and I paid $500,000 for it and it's worth $400,000. And so I'm underwater. Back in 08, the borrower would say, well, I'm wasting my money. Why am I going to pay this mortgage? I mean, I have negative equity. I'm just giving money to the bank. I'll go rent something, or maybe, I'll buy something else at a lower price. But even if you bought something at a lower price, if the mortgage was 8% and not 3%, even if I got a better deal on a home, my monthly payment is going to be higher. And the same thing with rent. A lot of people might be living in a home that they paid $400,000 for, that's worth $300,000 or maybe even $200,000, but their mortgage is so low that if they just walked away and they rented a property, their rent would be higher. So it's like, doesn't matter that I'm giving money to the bank. I got to live somewhere. I'd rather give it to the bank than a landlord. So that's an incentive for people to stay in their homes and continue to make payments, even if they have negative equity. So that's going to keep some of the supply off the market, maybe a lot of the supply. And it also means that people might rent out their house rather than just selling it because if you sell it, you lose the mortgage, right? It goes with the house. And these mortgages are not assumable. So the new buyer can't get it. But the renter can benefit from your mortgage because you keep paying the mortgage and he gives you rent. And if the market crashes and then the Fed is able to slash rates and mortgage rates come way down again, that would change the dynamic.
Prices.
There's going to be people, even with a low mortgage, that can't make the payment, right? Because they lost their job, or they have a job, but it's they're not earning as much, and so there's still going to be people walking away. There's still going to be foreclosures. One of the things that happens too, and this happened before, people will decide they're just going to stop making their mortgage payments, and they're not going anywhere but it could take the bank years to get you out of there. And especially if, the government comes in with some kind of forbearance where, you can't evict anybody, you can't foreclose on anybody because, it's an economic emergency. So you create another moral hazard. But the other thing that happens too, when people have negative equity in their homes, they don't make repairs. Sometimes they don't even pay their property taxes because it just, it just adds on to what, and what happened too, and this is one of the things that I predicted even before 08, is that people, once they knew that they were going to default on their home, they started, they taking the plumbing. They figured, hey, they take the fixtures out, start selling it, because by the time the bank got the house back, it was an empty shell. And you can't really sue the homeowner for the way he used his property. It's like, what happened to the granite countertops? What happened to the appliances? What happened to the copper plumbing that was in the house? It's a very precarious situation, for the lenders. But again, the thing that's going to happen also this time is very high inflation. So in nominal terms, prices might not drop a lot. But in real terms, right, if you want to compare what does a house cost compared to, a bag of groceries, or a gallon of gas, you're going to see that the real price of real estate has come down dramatically. A better way to price it would be in gold, right? So if you look at, gold's about $2,000 an ounce. So a house that's $200,000 is 1,000 ounces of gold. Now, that house might go up from 200,000 to 300,000. But it might go from 1,000 ounces of gold to 500 ounces of gold, right? So it doesn't matter that the price has gone up in dollars. It's half off in real money. And that gives you a better measure of what's happening. Well, I was telling people, before rates went up, I said, look, buying a house is an okay deal if you get a 30-year mortgage in the threes, because that's a great deal, to get that cheap money. So even if you overpay for your house, it's okay because of how cheap the loan was. But now that the rates are higher, it's not as clear cut. You're paying 8% now instead of 3%, right? But I still think that there's going to be a lot of inflation to wipe out the mortgage. So it might depend on where the house is, what you're paying for it, the neighborhood. I like to look at, the construction costs or replacement costs. I mean, if you can buy a house for less than it would cost to build it and the land is free, then it's like, okay, it makes sense because, I got the land for free and I bought a house for less than it would cost me to build it, then you could do it. I mean, like when I bought this house that we're in right now, I bought it for probably about what it would cost me to construct it. And so there, without it paying for the land. My house I had in Connecticut when I bought it, yeah, that was the dynamic. I mean, I bought it after the '09 crash and I paid less than the cost to build it with the land for free. And the property still went down even more after I bought it because the market was really bad over there. But if you like the property and it's relatively new and you know what it would cost you to build it, I think construction costs are going to go up quite a bit. Their materials and all that. Labor is a little bit harder, although that could go up too, especially if a lot of the workers aren't here anymore, because maybe there's a lot of foreign workers that were coming in and they're not here. But I think there's going to be a lot more unemployment, so maybe some people will start working construction. I think in certain high-priced areas, like in California, and there can be really big drops still. I mean, because you're talking about prices that are so much higher than the median income that were really a function of the credit, and where the tax base is deteriorating, crime is rising, so you have that migration of people leaving. Obviously, if you own real estate in one of the states or communities where a lot of people are relocating to, right? You've got buyers coming in, but if there's a net migration out of your state now. Let's say in California, some of the people that are coming in are not home buyers. It's the people who are leaving that are homeowners. And you can't sell your home to somebody who doesn't have any money. A lot of people were convinced that their residential home was an investment. And I was always trying to tell people that that's not the case, that real estate could be an investment if you buy it, and it cash flows and you have tenants and, it works. The math works where you get a good return on your money, right? You have positive cash flow, and, you can scale that up and it's an investment. But just buying a home that you live in, it's not an investment because, your property is depreciating over time. I mean, it's just like your car is not an investment. Other than the fact, well, I need a car to get to work. Well, that's true, but you can get a used car and still get to work. You don't need a brand new car, right? So you need a place to live. You need shelter, but people, you don't need an opulent place. You buy that because you want it. But over time, it loses value. It's not new anymore. I mean, and look, especially here in Puerto Rico, almost every year I have to paint this house. I mean, I'm near the water. And so, it's the maintenance costs are incredible just to keep the house from deteriorating. But so I always told people, look, a house is an expense. It's not your investment. Yes, you're not paying rent to the landlord, but you're paying a mortgage, you're paying property taxes, you're paying maintenance costs, right? All that stuff. Investments pay you, right? You have to have cash flow coming in. If it's a money pit, it's not an investment. But people just thought, well, my house is going to go up in value. That's what makes it an investment. Well, no, it's not guaranteed to go up. In fact, it's supposed to go down. Everybody knows what a tear down is, right? A tear down used to be a brand new house that had a lot of value, and now it's worth nothing. Now the land can kind of hold its value, but not necessarily. It depends. I mean, land could lose value or gain value depending on other factors. But the actual structure is not going to appreciate. It wears out, and over time, it's worthless, and then you have to tear it down. Apart from protecting the lender, which is what a down payment does, because you're less likely to walk from a mortgage if you've got equity from the beginning. And so the bank has that cushion. But the other thing that the down payment does is, in order to have a down payment, you got to save your money. You had to have an ability to have enough cash for a down payment. Well, when you're a homeowner, you need savings. You need to have money so that if something goes wrong, the roof caves in or, some pipe bursts or something happens, that you could cover the cost. And a lot of things are not necessarily covered by insurance because there are routine things that are going to go wrong, and you got to pay for it. When you're a renter, right, you don't have to worry about this stuff. That's part of the appeal of renting. If something goes wrong, you call the landlord and he's got to pay for it. You're just responsible for your rent, right? Maybe your own utility bill or stuff like that. But if something breaks, he's got to take care of it. But when you own the home, that's all on you. So you don't want people coming in and buying a house that have no savings and just got into it because it was a guaranteed government mortgage. They had no down payment and they're living paycheck to paycheck and they're a homeowner, because you can't be a homeowner if you're living paycheck to paycheck. You gotta have savings, which very few people have. So we've encouraged a bunch of people who shouldn't even think about owning property now own it because of all the subsidies, because we thought, we got to get everybody into a home so they can get rich being a homeowner. You can go broke being a homeowner. It's better to rent and then save the difference, because a lot of times renting is a lot cheaper than buying. You don't have all these other expenses. And of course, you don't have to, you can have an apartment. You get some single people, a single guy, in his 20s going out and buying a house. What are you buying a house for? Save your money, rent an apartment. Plus, if you buy a house, a lot of times it cuts off your mobility. You don't have the ability to take a better job that's further away because you're stuck, by your house, unless you could find somebody who's going to buy it. But we kind of conned a lot of young people into thinking, you got to buy a house because that's how you make money. Although now, of course, most young people are too broke to even rent. That's why they're living at home. In fact, we have a record number of people now of children, adult children, living with their parents, more than at any point in history.